Tell me the stock market's overvalued without telling me the stock market's overvalued. Anyways, the stock market is in one of the biggest bull runs in history in kind of a preposterous time. I mean, unemployment is still fairly high. Consumer spending is still fairly low, but the stock market has really just been doing better and better and better with a few exceptions of some minor corrections in the last year or so. Recovery happened in the stock market so quickly relative to actual recovery in the economy. And we're taking a bit of a tumble in the stock market as I'm speaking right now. So I wanted to go over an indicator that will really tell us where we're at in the stock market and help guide us to where we may be. Now, there's a lot of considerations here and there's many different indicators, but I feel like this is a very good one. But first, I'm going to start with a couple other indicators just to help build the picture here of what exactly is going on, how this can affect every single investor, whether you should buy right now, whether you should hold. I mean, timing the market is always hard, but this definitely will have some form of impact to you and your investment. So let's just go ahead and jump right in. So first, I wanted to talk about the S&P 500 P to E ratio. So let me pop over to the computer here real quick. And if you're not familiar with the P to E ratio, it's the price to earnings ratio. Typically, we talk about the P to E ratio just in terms of valuing an individual stock. It's basically how much do you have to pay for that stock divided by the earnings per share of that stock. So you can figure out how much you can expect to earn for one share of each stock owned. Well, we can also see these calculations for the entire stock market as a whole. In this case, it's the S&P 500, which helps give us a baseline and let us tell whether the whole market is overvalued or not. So we can see through time, there's all sorts of peaks and valleys here, price fluctuations, and we have an average P to E ratio over the history of the stock market of 15.88. We can see a huge spike here that's literally off the charts. The definition of off the charts, you can see the maximum is 123 in May 2009, and we all know that that didn't pan out so well. Our third highest is where we sit right now, the second highest being the tech bubble in the early 2000s. Third highest, this is where we're sitting right now. And this isn't even the scary indicator. Now, moving on here, we have the Shiller P to E ratio. This one's a little bit of a better indicator because it takes inflation into account and averages out some of the short-term fluctuations. We can see here the average P to E for the S&P 500 is 16.78 in this case, slightly higher. We can see this sets us at the second highest it has ever been in the S&P 500. With inflation and short-term fluctuations taken into account, 2009 actually wasn't so bad. 2000, the internet bubble was the worst. So we're sitting at the second worst according to the Shiller P and E ratio. You can see the maximum here is 44.19 and we're at 35, more than double the average. And then from here, this is another good indicator. We have the S&P 500 earnings yield. This is basically the reverse of the P to E ratio. You take your earnings divided by the average price, and this will tell you your average rate of return just in the stock market, your percentage of return. We can see this has fluctuated all over the place. In the early 1900s, back in 1915, the average was about 19% returns in the stock market as a whole. I wouldn't mind some 19% returns. We can see in the 1950s, we're at about 16%. In the 1980s, we're at about 14%, all pretty good. And we're seeing it slowly decline. And it bottoms out here at 2010 at less than 2%. We can see right now we are, it's hard to tell exactly. It looks like we're at the third lowest it's been since the stock market has started, the lowest being in about 2004, it looks like. So what this tells us is just how profitable it is to invest in the stock market. Now, something to consider with this ratio is this is a comparison of other investments. You want to compare this to what returns you can earn in other investments. And typically when comparing stocks, you compare it to the bond market. And the bond market pretty much goes in line with current interest rates. Current interest rates are practically zero. So you're not going to earn much with a bond in the bond market right now. You're not going to earn much more than you would in a bank account, which is pretty much zero. So if we compare a bond yield, which is near zero, to a 2.5% return, I'd rather a 2.5% return. And this is part of the reason why we're seeing the stock market continue to grow. But I'm going to talk about that a little bit more later after we go into this next indicator. And this indicator is the Buffett indicator. And also this website is currentmarketvaluation.com. They do an amazing job of keeping track of this thing. But the Buffett indicator is the total market cap relative to the United States GDP, the gross domestic product, basically the value of the final goods and services that end consumers buy. You can think of it as what the US is actually producing. So what the prices are of US companies divided by what the US companies are producing. Warren Buffett says this is probably the best single measure of where valuations stand at any given moment, and he knows a thing or two, so I'm going to trust his judgment there. In a typical investment, you want to purchase something that's priced less than the value, or at least the lower that ratio, the more you're going to earn. That's what the P to E ratio is. This ratio tells us what theoretical rate of return you could receive if you invest in public companies in the US. Basically, if you calculate this ratio and it's higher than 100, there is some case to be made that stocks are overvalued. And the further it is away from 100, the more reason there is to say that stocks are overvalued, and the lower it is from 100, the more argument there is to be made that stocks are undervalued, which doesn't really happen that often. It kind of wavers, which we're gonna break this down so you can really see what this means. We can see that the Buffett indicator is currently 80% above average, or 2.6 standard deviations above the historical average. Now, a standard deviation is used to understand a specific data point and to understand whether that data point is standard and expected or unusual and unexpected. Basically, the larger the standard deviation, the more unexpected that data point is. And 2.6 is very high. Let me just show you here. I pulled up some graphs. We can see here's the standard deviation rule. We can see that at 2 standard deviations, 95.45% of all results fall within 2 standard deviations. We're at 2.6, and three standard deviations is 99.73%. So about 2.6, we're in the high 90s, 98-ish percentile, which means the results that we're seeing right now have the odds of about 2 or less percent of happening. They're very unlikely to happen to see results like this. Just to put this into a more realistic comparison, we can compare it to the height, the average height of men and women. So just to talk about the male height, we can see at about 2.6 standard deviations, that's about the same odds as someone being about 7 feet tall. High 6s to 7 feet tall. Now, if we go back over here, that kind of builds a better picture of how crazy this is right now. And we can see the Buffett indicator is actually the highest it's ever been in tracked times. The second highest being the tech bubble, where we were just above 2 standard deviations. And we can see if you look really closely, we touched the 2 standard deviations mark back in about October of this year before we saw a correction. And then we just blew past that to see the highest it has ever been. Now, this website offers some amazing data, so let me just cover what exactly is going on. And first, we can look at the total market value, which is represented by the Wilshire 5000, and we can see that this goes up almost exponentially. But if we look at the quarterly GDP, how much is actually being produced and purchased by end users in the US, this line is more linear in nature. It's more flat, where this is spiking up. And of course, we can see it's nearly a wall at this point. And when we compare the two, we can see that there's a strong case to be made that there is a regression to the mean always. Sometimes it's above, sometimes it's below, but always at some point, it comes back down to Earth. And right now, we're the furthest away from Earth we've ever been. We're frankly in the stratosphere. And then here we can see the Buffett indicator when compared to a straight line, just so we can see how much it is actually moved. And here's a more recent historical trend, just compressing it down from 1990 through the end of 2020, just so we can see a little bit more data points on here. And this is some criticisms of the Buffett indicator, at least as of right now. So I don't want to be a complete doomsayer because situations are different than they've ever been. As I mentioned earlier, interest rates are lower than really ever. At least they haven't stayed this low for this long, which means typically in an investment, you are comparing your investment in whatever you're buying and hopefully receiving a return on. You're comparing the average investment to your investment of anything else. Now, anything else could be bonds, could be real estate, it could be cryptocurrencies, I guess. That's not a consideration of the Buffett indicator, but typically we compare it to bonds. And bonds, like I said, are very closely linked to interest rates. Well, interest rates are extremely low, so kind of our best choice is to keep pumping money into the stock market. Beyond this, we have the amount of cash that has been plunged into the system, which means there's more cash floating around, more cash going to businesses, more people investing than ever. We also have a change in sentiment. Young people are just much more interested in investing in stocks and equities and investments than ever before. I mean, I have never seen such a hype on my channel. I've never had so many people reach out to me and ask questions about what stock should I invest in? How do I start? These things will lead to the stock market going up more than average, 100%. So the question is, how much of an effect will that have? Let me pull this back over here real quick. We have the Buffett indicator versus Treasury bond rate. So we can see there's almost an inverse relationship here, where Treasury bonds, you can see the higher Treasury bonds are, the lower the Buffett indicator. Right now, we are at the lowest Treasury bond rates, and the Buffett indicator is the highest. Now, of course, in the short run, no one can guess what exactly is going to happen in the stock market. There's a very strong case to be made that prices are fairly high. In the short run, they could go higher, but in the long run, there will be a regression to the mean. At some point, things will come back down to reality. It's nearly impossible to time the market. So I think it's always best just to dollar cost average your investments, put in a little bit over time, and over a long enough period of time, you will come out better in the end by just doing that simple dollar cost average. Now, if you are interested in the stock market at all, if you want to get a couple free stocks, you don't even want to have to spend money to get some investments in the game, you can check out Webull with my link in the description, and you get 2 free stocks valued up to $1,850. All you have to do is deposit $100. You don't even have to spend the $100, and you'll be good to go. If you have any questions about the markets or what exactly is going on, feel free to ask them in the comments. I'll do my best to address as many as I can, and I would like to thank you for watching, and I hope you have a profitable day.